Okay, that's great. Well, good afternoon, everyone, and thank you for joining us for the third Link Growth Fund Investor webinar. Sorry about that. My name's Nina Dunn, and I'll be moderating today's webinar. Joining me is founder and portfolio manager Chris Cuffe. We're also very pleased to have Rob Tucker from Chester Asset Management and Eleanor Swanson from Fire Trail Investments, who will walk us through their respective funds and their current positioning. Before we hear from Rob and Eleanor, I'm going to hand over to Chris. He's just going to give a brief fund update, I guess, including the fund's objectives, recent developments, and the current manager lineup. So, Chris, I'll hand over to you.
Thank you very much, Nina, and welcome everybody on the call. Look, Third Link structure, for those who don't know, is fairly straightforward. It's an Australian equities fund of funds. So it invests in underlying Australian equity funds run by groups that we've researched and have a lot of time for, and who we think together will be able to get a good result. But one of the very unique features is that the underlying managers have all waived their fees, both management and performance fee, and the management fee that Third Link charges is all donated to charity. So that's in essence what this is about. And it's really the whole thing works because of the generosity of the fund managers, like the two we have on today. But look, the first thing I really wanted to talk about in the key highlights, before I look at these individually, it's been a tough period of time, there's no doubt. The last 3 or 4 months has been as tough as I've ever seen in my investment career. And I guess one of the things that calls into question is active management alive, or is it dead? There's a lot of people who do use index funds these days. Third Link invests in underlying managers who are active managers, actively attempting to beat their various indexes by really thinking through what they're doing, not just blindly allocating capital based on the market cap size. Now, plenty would say active managers have been hit hard in the last few months, no doubt about that. But I have to say again, in my career, I have seen this come and go, and over time, I believe active managers, particularly in Australian equities, do prevail. In fact, it's important that they do prevail, because the index managers have to follow something, and they can only follow what the active managers do when you think about it. But this is a period where people, because of geopolitical issues, very dire issues going on, where people have tended to flock, investors tend to flock to very big cap stocks, regardless of their value. And I would certainly say the value in the biggest stocks in the Australian share market is very questionable. So I see this as a period to ride out. There's 12, but into some of the detail, the fund has been going for more than 17 years, produced a return of over 9% per annum, or around 9% per annum, I should say, about 140 million in size. But really key is that it has donated just on $25 million to charitable organisations over its life. So that's what's really key in this. Now, when you look at the underlying managers, if you go to that slide, Nina, there's 12 underlying managers that we invest through, that your money is invested through. These are managers that I know very well, that have been operating for some time. I have great conviction in their ability to achieve positive results. But like I said, this is a fund of funds. So my fund, Third Link Growth Fund, is only as good as what the performance of the underlying managers are. And it's just a difficult period. I don't think it's a time at all to knee-jerk to short-term performance or short-term events in the world. History shows us that repeatedly. So I'm very much, having made a number of changes over the last year and introduced new managers like the managers we're hearing from today, I'm very satisfied that the portfolio is in good shape, and I think it will prevail as the world settles down and people come to look at what is the true value of individuals' stocks are, rather than just blindly allocating money to based on the size of a company in the index. So look, on that note, one other thing I did want to talk about. In the last 12 months too, there's been a number of changes on the governance side of this fund. If you just go to that slide, Nina. So we have a new what's called a responsible entity for this fund, which is Evolution Trustees. We have a new registry provider and a new external auditor. And the reason we did those changes is we were looking to improve the efficiency of the overall fund, and we believe we've certainly achieved that. And along the way, the costs came down as well. So the cost has a lower management expense ratio than it's previously had, and the efficiency, we believe, is being far enhanced. I'm just going to ask Nina, before she hands to Rob, to talk about the donation side, the impact it's having and how we measure that. So I'll just hand back to Nina now.
Sure. Thanks, Chris. So, I think what Chris said is it's one of the things he's incredibly proud of, and I'm very proud of too, to be working here, is that the fund continues to have returns beyond, it continues to have beyond investment returns, like an impact. So over the past year, we just recently published our inaugural impact report, and that outlines the charities we've supported and the tangible difference that those contributions are really making. So I'm very happy to share a copy of this report for anyone who'd like one, or it's also available to download on our website. And it goes through, I guess, the three main focus areas, which in partnership with Australian Philanthropic Services, the giving areas around Amplify, so supporting initiatives that elevate voices of young people and just ensure they're active participants in decisions that are helping shape their futures. Employment, so creating pathways for employment for disadvantaged people and risk at youth. And catalytic impact, which I know is a big thing in today, so backing organisations that really drive systemic change and contribute to informed public debate. So it's great to see that, thank you for staying invested with us, but your monies are also producing strong investment returns along with a really strong community impact. With that, I'm going to hand over to Rob Tucker from Chester Asset Management, and he's going to walk us through the Chester High Conviction Fund, including portfolio construction, risk management, and performance. So, Rob, I'll hand over to you, and you just direct me for when you want me to change slides.
Wonderful. Thanks, Nina. Thanks, Chris. And look, I'd say Chester's really pleased to be involved with this initiative. I think it's a great cause. So we're very happy to donate our time and best endeavours to make generate the alpha for the fund. So if we just flick over the next slide, Nina. Chester's been around since 2017. We've been running this same strategy since 2013. Anthony, Luke, and I have all worked together for 15 years. And we've hired Luke and Tom in the last couple of years, and we have another analyst starting with us in August. So we've had strong growth through performance, and the product is different, which I'll touch on in a minute, but that's just a little bit about Chester. We are 100% owned by the employees, and we use Copia as our distribution partner. But let's touch on Chester. So maybe the next slide, Nina, please. And if you just flick through these, this is really a simple language that I use. And it's simple because I'm a simple person, but the Chester High Conviction Fund is a very benchmark unaware strategy. So in aggregate, it would be described as a mid-cap strategy, but in essence, we have all caps. We have some micro caps up to large caps, and we really are just trying to invest where we see asymmetry of risk. And that's what the language I use all the time. A lot of the alpha generation we have delivered, it has come from unloved, underappreciated or undiscovered assets. So that's really, we think with a contrarian mindset. So with that in mind, we use this framework to construct our portfolio. 60 to 70% of the money is allocated to what we would call predictable cash generating industries. such as healthcare or infrastructure or staples or real estate. We're very happy to allocate to cyclical sectors that are obviously driven by the economic cycles, but they can be notoriously volatile. You think commodity prices can go up and down very quickly. So we tend to allocate between 15 and 25% of the fund to cyclicals. And then we have always allocated to gold equities. And I'll touch on why in a minute, but it tends to be non-correlated to the ASX 300 over a 5, 10, 15, 20-year time frame. The last 12 months has been more correlated. But historically, gold has been uncorrelated. And as is cash, it's called cash and option buy something cheaper in the future. So if we go to the next slide, please, Nina. So we think in these three buckets, I call them buckets. So it's, again, simple language, 67% in predictable cash generators. It's about 25% in cyclicals right now, but you can see how that's trended over the last 12 and a half years. And then it's about 13% in cash and gold. So we have always run this strategy, and I call these my macro guardrails. I don't know when Trump's going to bomb Iran or when he's going to do a ceasefire. So those things are very hard to predict. So I don't try and forecast macroeconomic cycles. I try and allocate these buckets consistently and then try and pick the right stocks within these three buckets. So that's how we've consistently allocated across the portfolio over 12 and a half years. If we go to the next slide, please, Nina. And so this is the alpha generation of the fund over 12 years or 12 and a half years. So we've been pleased with the returns over a long period of time. But what we try and highlight for the fund and the strategy is the table on the bottom. And that shows you the beta of the fund is 0.83. So that means because that portfolio construction framework, always having allocation to cash and gold, some cyclicals, and that predictables bucket, we find we have some part of the portfolio that is working well in different parts of the cycle. And that leads us to run a fund with lower volatility in the overall market. And the number that we're probably most proud of on this slide is the down capture ratio. So that says, that number on the bottom table says when the market falls 10%, our fund on average falls 6.7%. So we are very much trying to protect capital first and then grow with the market. But trying to protect first is very much part of our philosophy. And that gets back to allocating capital in an asymmetric manner. So the next slide, please, Nina. And this is probably just an example of that over the 12 and a half years we've run the strategy. The grey bars are when we've outperformed or underperformed. The table on the right-hand side shows that when the market is negative, the fund outperforms 80% of the time. And again, that's very much a testament to that portfolio construction frame that we've been really consistently applying for that period of time. Again, next slide, please, Nina. So I think when we started with a very benchmark unaware strategy, and so agnostic that CBA is 11% of the index or BHP is 10% of the index, we are trying to find stocks that have thematic tailwinds. So this is longer than the economic cycle. These are structural tailwinds behind an idea. And we think the most influential idea in the next 10 years is the government debt levels. So that is Western governments spending more than they've been earning, and they've been doing it for, well, the US has been doing it for 25 years, and so is Japan. So the Western governments having this ongoing relentless deficit spending leads to this monetary policy debasement theory, which is why we've always had this allocation to gold equities. The other four mega trends are obviously quite well known, and I think the one that's really obviously front of mind at the moment is the geopolitics, in terms of what that means for food security, supply chain security. And so we've been thinking a lot about that in the last 3 months, obviously. And I guess there's still an uncertainty around how long that lasts for. But I just put this slide up to basically demonstrate how we think about our idea generation. So our idea generation comes from these 5 mega trends, and then we do detailed research from this megatrend framework to come up with our portfolio construction. So can I have the next slide, please, Nina? So this is the top 10 holdings at the end of the March quarter. And you'll see they're very idiosyncratic ideas. So a lot of these are very stock specific in nature. Ampol is clearly benefiting from higher refining margins at the moment. And we would say it's been remiss of the Australian government over the last 10 years, irrespective of who's in power, that Australia only has 30 days of refined fuel supply in the country. The IEA says we should have 90 days of fuel supply. So I think it tends to lean towards Ampol and Viva's refining assets being treated as scarce assets and very much of strategic merit. Historically, they've been treated as very deep cyclical assets that earn between $0 and about $400 million of earnings a year. But the government is going to underwrite the way they generate profit from those particular refining assets, called the FSSP. And I think the market will come to realise that these are strategic assets that are going to be earning a lot more than that with less volatility in the next 2 to 3 years. So I think the value ascribed to Ampol's refining business should see an uplift in the whole Ampol business, including the retail convenience stores. So we think there's a strong tailwind behind Ampol as an infrastructure type play. So you can see that there's a very wide range of stocks, very idiosyncratic ideas. The one thing I'd say, and we've been very focused on this for the last 2 or 3 years since the advent of AI, you can see the 4 columns there, how we think about investing. There's a quality lens to how we think about the assets, either in the ground or the company in their industry position. Very strong valuation focus. The insight is, do we think we have a particularly unique insight to why the stocks will re-rate or have earnings surprise? We don't confess to always have an insight into why the stocks will re-rate or have that earnings surprise. But obviously, if we do, and we think the market is mispriced in those earnings, that then leads to a high conviction outcome. But we show here real assets. So we've been very focused on assets that the AI, industrialisation of AI cannot disrupt. It can't disrupt AGL's electricity generation framework. It can't disrupt Cube Logistics ports or Mineral Resources mining services business. So there's been a real focus of our fund to have real assets on the balance sheet and assets that are very hard to disrupt. Next slide, please, Nina. Now, it has been a challenging period for the fund in the last 3 months, and this is one of the reasons, because so I've always had to lean into ideas that haven't yet worked, and Austbrokers has been really sold off aggressively on the fears that insurance broking will be disrupted by AI concerns. So we have a lot of clients that are actually insurance brokers themselves. So I've had a lot of conversations over the last 3 months about what AI will do to your business or could potentially do to the business. And I'm convinced, because it's a commercial arrangement between business to business, and a lot of the businesses that insurance brokers write policies for are very unique. So they're very bespoke and they need a tailored answer. So I'm very convinced that insurance broking with commercial lines won't be disrupted by AI. In fact, AI, I think, will help their productivity, but not necessarily the relationship with individuals that are writing those particular policies. So you see the chart on the right-hand side shows that Austbrokers normally trades on about 16 to 17 times PE 1 year forward, and it's currently trading on 11 times. So I think it has been completely sold off with the AI fears, which I think are overblown. So this is an example of a stock that we've lent into, and this, when we think about asymmetric risk, I think the asymmetry of this trade over the next 3 years is far stronger, because I think the earnings growth will still be there. So I think we'll be really well rewarded over the next 3 years for the price we're currently paying for that earnings growth over the next 2 to 3 years. So that's just an idea that we've been adding to recently. Next slide, please, Nina. And I've got a couple more slides before I hand over to Eleanor, but you can see here the metrics of the fund. So I look at the PE ratio 1 year forward. So that's FY2 on the table at the top is showing you the PE ratio in FY27. So the market is currently trading on 16.4 times because the top 20 names are incredibly expensive. They're on 21 times, and the whole market is trading on 16 times. Our fund is trading 11 times 1 year forward. So this is probably the biggest dislocation our fund has had from the market since we've been running this strategy. So I think there's an incredible, like Austbrokers, like light and wonder. I think there's some really strong, compelling ideas in the mid-cap space as we see today over the next 2 to 3 years that have been really sold off for various reasons. So it just shows you how different our fund is from the benchmark. So you can see the market cap exposure in the bottom. It is a mid-cap bias. So we have about 57% of the fund in the top 100 and about 40% outside the top 100, which is historically how we've run this particular strategy. So it is run with a high active share, which means the tracking error. Our fund is very different from the market in essence. And maybe I'll touch on the last slide, Nina, because I'm very passionate about this. And I think Chris touched on it. The reason active managers have had a very tough 2 to 3 years is the chart on the left-hand side. The re-rating of the bank sector has been quite spectacular. So you can see that the literature on the left-hand side, the bank index has given you 26.4% per annum over the last 3 years, or 103% in total. 65% of that has been pure re-rating, i.e. the stocks are trading on higher valuations. And you've had some earnings growth, about 14.5%, and some dividend growth of about 9.5%. But most of that outperformance in banks, again, banks are economic cyclical entities. And so I tend to think they should grow in line with GDP and give you 7 to 8% total return through a cycle. Our ambition is to give you double-digit returns over a cycle. And so we think we can actually ultimately allocate capital better than relying on banks that might give you 7 to 8% return. But for banks to give you 26.4% per annum for the last 3 years, into the structural tailwinds or headwinds I think we see now in terms of the stagflationary environment that we're entering into, the chart on the right-hand side shows you the impairment cycle over the last 25 years. So you can see impairment charges in the bank sector are almost as low as they've ever been. And so one basis point of impairment leads to 1% downgrade to EPS. Impairments average 23 basis points. They're currently 7. So if you saw impairment charges in the bank sector rise back to the long-term average, you'd imply a 16% earnings headwind or earnings downgrade. And we've seen Westpac this morning actually lift their provision charges for the upcoming result from 7 basis points to 10 basis points. The bank sector has such a strong re-rating because it hasn't had downgrades. In fact, it's had slight upgrades the last 2 or 3 years. We think we're in the middle of that reversing and starting to see the economic conditions deteriorate, which should see bank earnings revisions slightly down, in which case CBA won't be on 27 times 1 year forward, it'll be on 15 or 16 times 1 year forward. So we, again, think in asymmetric terms. The asymmetry of owning banks here, I think, is extremely poor, given the earnings headwinds I think the banks are about to face, given the stagflationary environment we're currently in. So that's a long-winded sort of way of saying I think having mid-cap exposure with real valuation support is a far better way of allocating money in the next 3 years than allocating money to the top 20 names, i.e. the bank sector. And remember, the banks are 26% of the index, so they are very influential in the way the ASX 300 performs. So with that, I'll leave it with Eleanor to talk through her fund.
That's great. Thank you so much, Rob. I think that's you shared some really good insights on, where active management is and I guess how concentrated the indexes are and heavily weighted they are towards the big banks and stuff. So with that, I'll hand over to Eleanor Swanson from Firetrail Investments. Thank you, Eleanor, to talk through the Firetrail Australian Small Companies Fund. Over to you, Eleanor. Oh, I think you might be on mute.
I am sorry about that. All right, I'll start that again. Thank you, Nina. Thank you, Chris. And just to echo Rob's words, Firetrail is also very pleased to be partnering with ThirdLink. So I'll just move on. Next slide, please. Just to give you a little bit of an overview of Firetrail to start off. We'll then dig a little bit deeper into the fund I work on, which is the Firetrail Small Companies Fund. And then I'll give you a bit of an overview of the outlook for markets, particularly in small caps, and then we'll dig into one of the key holdings in the fund. So if you're not familiar with Firetrail manages $5 billion, predominantly in Aussie equities. The Firetrail Small Companies Fund, which Third Link is invested in, we're managing $900 million. And we are managing the fund to a different benchmark to the benchmark Rob was talking about. So it is the ASX Small Ordinaries benchmark, and we'll dig into that in a little bit more detail. We have a team of 19 investment professionals working at Firetrail. We were the ex-Macquarie High Conviction team and started the Firetrail business 8 years ago now. Staff own 75% of the business, with the remaining 25% owned by Pinnacle Investment Management. So next slide. So these are the 5 funds managed by Firetrail, and I'll just draw your attention to the ratings of the funds. You can see we're very highly rated by both Zenith and Lonsec, and we're also top quartile across the 5 funds in the Mercer survey, so really strong performance there consistently across the funds. All 5 funds do apply the same investment process, so it's style agnostic. We're not growth, we're not value. We're trying to give you a blend of both. They're concentrated portfolio, and we're picking stocks bottom up. Next slide, please. This is just a quick snapshot of the Firetrail Small Companies team. So you can see there's 3 portfolio managers that work on the strategy. We've got a full-time analyst in Carter Ryan, 2 full-time dealers, a risk specialist, and Katie Ryan, who looks after putting together presentations like this, with the objective of the investment team devoting 100% of their time to either portfolio construction or stock selection. Next slide. All right, so let's dig a little bit deeper into the small companies strategy. So just on the next slide, we've given a bit of an overview of our investment philosophy. I'll just wait, sorry, there we go. So there's kind of 3 tenets in the Firetrail philosophy. The first is that every company has a price. So what we mean by that is we're not filtering out growth companies or value companies. We're really looking to uncover companies that have derated relative to where they've traded at versus the market's price to earnings. If they have derated, that's a catalyst for us to go and explore if that's a structural issue, or perhaps if the market's just pricing in more negativity than is warranted. We'll look at both growth and value stocks. We're not targeting a style neutral portfolio. We'll have periods where we're slightly overweight value or slightly overweight growth, and that's really depending on where we're seeing the most opportunities in the market. The second thing we're looking at is we spend a lot of time forecasting earnings. So we strongly believe that share prices will follow earnings. So if we get the earnings of a company right, we're likely to get that share price right as well. Whilst we do look at valuation, we won't buy into a company if we expect there's a material earnings downgrade coming, material being 10% or more. At the next earnings update, we'll wait for that downgrade to flow through, because we have seen, even cheap companies, if they miss the market's expectations on earnings, they will still trade down. And really the objective of the fund is to identify companies that we believe are undervalued on a 3-year view with limited risk of a material earnings downgrade. So the next slide really digs into how we believe the fund is different versus peers. So what we've done on the left-hand side is break down the Small Ords benchmark into 3 key buckets. And you'll see in the green bucket, that's the industrials part of the market. So that's where we see a lot of our peers play. It's 2/3 of the market. You've got your typical household names like a Bega Cheese or a Nick Scali in that sector. And we actually see a lot of managers in the small cap part of the market exclude resources and also exclude biotechs. We believe you do need to have industry expertise in these parts of the market because risks are really elevated in these sectors. So we're very fortunate at Firetrail to have the portfolio manager on this strategy, Matthew Fist. His background is geologist and he was a mining engineer at BHP for many years. It's an incredible asset given how significant resources are as a sector in our benchmark. So 34% of the benchmark. And actually, we have seen significant bifurcation of the small industrials versus the small ords, even just this financial year. The small industrials benchmark is down close to 15%, whereas the small ords benchmark is only down 7 or 8%, and that delta really is being driven by resources, and we've seen particularly outstanding performance in gold. My background, I'm an immunobiologist by training, which gives me the ability to look at clinical trial data. So we do see, there's some really fantastic opportunities in this part of the market. In Australia, we've got a very strong university system. However, risks are elevated given we're dealing with clinical trial risk, tends to be binary. So we do size the positions accordingly. However, if you get them right, there's significant alpha potential. And you can see in that top right bar chart, this is the attribution of the fund or the outperformance of the fund broken down by sector. And I think what's really important for investors is you can see that our alpha generation is diversified across all sectors of the market, which we believe means it's much more reproducible looking out over the next 3 years. Next slide there. So this is just a snapshot of the performance of the fund. This is before fees, which is most relevant for third link investors. And you can see the fund has delivered 15% outperformance versus our benchmark, or 19% per annum since inception. And we've also included our track record from managing the fund back at Macquarie. The fund at Firetrail was launched in March 2020, but we did manage the fund from 2017 at Macquarie as well. All right, so now just digging a little bit more into the market outlook. So this is really, I think in a nutshell, why we think it is important to have a combination of both value and growth stocks in the portfolio. We strongly believe that the best approach to investing is a style agnostic approach. And that's been proven out over the last 20 years. You can see there have been very strong growth value cycles in the Australian market. And in the last 12 months in particular, we saw growth stocks last year significantly outperforming, and that dramatically reversed with the release of some of the new AI tools earlier this year. So it's really hard to pick these cycles. So we think from an outperformance perspective over the medium term, you really want to make sure you have both growth and value stocks in your portfolio. So the next slide just digs a little bit deeper into the AI software sell-off. It's been, it almost feels slightly out of date, this slide, given the Iran war, but we are still seeing significant bifurcation in the performance of the technology index versus the small ords benchmark. And that's really being driven by the tools released by OpenAI, Anthropic and the like, and people just questioning the terminal value applied to some of these technology stocks. We think the sell-off is warranted. So we've had a few investors ask us, should we go out and just buy a basket of technology stocks? They're screening so cheap relative to history. Our answer is no. We think that there really is two baskets. There are potential losers, and then we think there are companies that have more of a moat. And basically, in our view, kind of a little bit of rule of thumb, we're thinking companies that are B2B, that have kind of more workflow tools that can be easily replicated by AI. They've got large EBITDA margins, 40%. They've been putting through 10% price rises per annum. We think they're at risk. Whereas companies such as a Life 360, which we own in the fund, has a significant moat in it's got 100 million monthly active users, very hard to replicate. And that big user base gives them the ability to negotiate much better terms when it comes to insurance, roadside assistance, and it also gives them a platform to grow advertising revenue. So that's kind of in a nutshell how we're thinking about the software sell down. This is a little bit of a snapshot of how the portfolio is positioned. If you're not familiar with how Firetrail thinks about positioning, we break down the index into 5 key buckets or thematics. So companies in the Australia bucket have the majority of their earnings facing into the Australian economy. I'd say we're relatively defensive in how we're positioned in this bucket. We do expect inflation to pick up, interest rates therefore to increase. So we think the consumer outlook is looking pretty tough. So our key exposures here are aged care, which I'll dig into in a little bit more detail on the next slide. And we've also got a defence position in Duratec. In terms of resources, we are quite constructive on the outlook for resources. We think energy is a really great place to be positioned given what's happening globally. Similar to Rob, who has Ampol as a key holding, we've got Viva Energy as a key holding in the fund. We also really like uranium as a transition fuel, so we've got NextGen in the portfolio as well. I've touched on global. A lot of that is your technology stocks. Yield, similar to Rob, we do think you want to own real assets given the inflation outlook. So we've got key holdings such as GemLife and Channel Infrastructure in that bucket. And we're currently underweight rate sensitive. So these are companies that are going to be punished if interest rates rise. Great, next slide. So this is our top holding in the fund at the moment. We've been invested in aged care for quite some time. So we owned Estia when it was taken out by Bain 3 years ago, and it's already coming back to market. And we think the outlook for aged care is really underappreciated by the market. So on the top left-hand chart, you can see the population of Australians that are going to be aged over the age of 80. Is on the increase. So there's about 6,000 Australians moving into the above 85 age bracket each year. And that's expected to increase to 20,000 per annum over the next 5 years. What we're seeing in terms of supply of aged care beds is that operators are not getting a good enough return on capital, and they're just not building. So you can see the shortfall on the bottom left chart in those pink bars, and that shortfall escalates by 20,000 underinvestment in beds by 2030. So it's pretty clear to us that the government funding, that the government hasn't got it right. And so we're expecting at the budget that they'll increase funding for aged care operators. A good example of this is we saw them increase the RAD retention to 2% for operators, which is significant. Regis has a RAD balance of 2.5 billion, so 2% on 2.5 billion is massive. We think likely what's going to happen next is they're going to really need to target construction of new beds. So we expect the RAD retention to increase to 4% potentially for greenfield builds. So we think there's significant upside just because of the supply-demand dynamic in this sector. We see 25% upside in Regis, and that's not assuming they continue to do accretive M&A. So it's a 4% overweight in the fund at the moment. So hopefully that's given you a bit of an insight into how we think about constructing the portfolio and a key holding in the portfolio as well.
Fantastic. Thank you so much, Eleanor. That was really great to hear about the Firetrail Small Companies Fund. Before we wrap up, if anyone has any questions, please feel free to submit them on the chat or Q&A option in the webinar. If we don't have any, or you think of one later, feel free to reach out via the details on the screen now. But I'll hand over. If not, I'll give it a minute or so. But if not, we'll finish up, and I'll give it to Chris to close us out.
Okay, thanks, Nina. And yes, if questions pop up while I'm talking and we don't have time to address them, we'll certainly get them offline to you. Anyhow, look, today you've heard from 2 of our 12 managers, and you can see the different styles of investing, concentrating in different ways. I think what's really key to understand about ThirdLink, it is a fund of funds. So it's a one-stop shop. Through a single investment, you get access to a group like this. This is a dozen managers. So administratively, it makes it very simple. But what's the key? The key here is that nearly all the managers that we use, if you were invested in their fund directly, and I think all their funds are great, but they charge performance fees as well as management fees. And that's required for managers who keep themselves focused on return and not just focus on gathering money for the sake of it. Performance fees are really important for their operations, for them to be economically viable. And through their generosity, they've waived these performance fees in the case of ThirdLink. So you get access to a dozen managers and you're not paying a performance fee. And we think that really makes it compelling. And, added to that, as you're seeing, there's different styles of underlying managers there. So thanks again for supporting ThirdLink if you're a supporter, and if you're not, I hope you come on board at some stage if the fund suits your needs. And thank you for joining us today. Now, before I actually say goodbye, Nina, are there any further questions? Any questions?
We're looking good to finish on time, which is great.
Okay, well, thank you to everybody.
Thanks, Rob. Thanks, Eleanor. Thanks, everyone.
Thank you.
Thanks.
Thank you.
Thank you.